A critical deadline is approaching for one of the world's most closely watched commodities markets. As of Tuesday, February 25th, 2026, market participants and analysts are focusing their attention on the COMEX silver futures market, where a significant delivery window is set to open in approximately 72 hours. Friday, February 27th, 2026, marks what is known as First Notice Day for the March COMEX silver contract, the date on which holders of short positions must formally notify long position holders of their intent to deliver physical silver against outstanding futures contracts. At the center of this story is a striking numerical imbalance. According to official CME Group warehouse data, COMEX registered silver inventory, meaning silver that carries a warrant and is legally available for delivery against futures contracts, stood at 88.79 million ounces as of February 19th, 2026. Against that figure sits the reported open interest for March 2026 silver futures contracts, which represents a notional exposure of approximately 529 million ounces. That figure translates to a ratio of more than 6 paper ounces for every single physical ounce currently available for delivery in COMEX registered vaults. The arithmetic at the core of this story is straightforward. If just 17% of outstanding March contracts ultimately stand for physical delivery, the total ounces demanded would exceed the total registered inventory currently on hand. That threshold, 17%, represents the point at which COMEX registered silver supply would be fully exhausted. It is not a majority. It is not even 1 in 5 contracts. It is fewer than 1 in 6. Adding to the significance of this moment is the recent trajectory of COMEX registered silver inventory itself. 4 months ago, in October 2025, that inventory stood at 167.7 million ounces. As of the most recent data, it has fallen to 88.79 million ounces, a decline of 78.91 million ounces, representing a 47% reduction in just 4 months. On February 19th alone, registered inventory fell by 3.36 million ounces in a single trading day. To fully understand the significance of this Friday's First Notice Day, it is important to examine the recent delivery history on the COMEX exchange, because the numbers from the past several months tell a story that stands in sharp contrast to what has historically been considered normal activity in this market. Beginning with February 2026, data shows that as of early in the month, 18.72 million ounces had been delivered out of a total February open interest of 19.11 million ounces. That represents a delivery rate of 98%. February is not considered a major delivery month on the COMEX calendar. The traditionally active delivery months are December, March, May, July, and September. February is classified as a minor month. Yet in February 2026, nearly the entire open interest position resulted in a demand for physical silver rather than a roll forward into a future contract month. Looking back 1 month further, January 2026 saw 49.4 million ounces delivered on the COMEX. To place that figure in historical context, January is described as one of the smallest delivery months of the calendar year. In January 2024, deliveries totaled 6.8 million ounces. In January 2025, that figure rose to 11.8 million ounces. In January 2026, deliveries reached 49.4 million ounces, representing 7.27 times the volume recorded in January 2024 and 4.19 times the volume recorded in January 2025. A month that has historically ranked among the quietest of the year for physical delivery activity produced more silver deliveries than most major delivery months in prior years. December 2025 also recorded a notable figure. During that month, 46,135 million ounces of silver were delivered through COMEX. That figure represented approximately 50% of the estimated free float registered inventory at the time, meaning roughly half of all available deliverable silver moved through the delivery process in a single month. Looking at the full calendar year 2025, total COMEX silver deliveries reached 474.4 million ounces. In 2024, the comparable figure was 202.7 million ounces. The 2025 total was 2.34 times greater than the 2024 total. Furthermore, every single month of 2025 recorded higher delivery volumes than the corresponding month in 2024, without exception. One institution has emerged as a particularly prominent figure in the January 2026 delivery data. JP Morgan issued 99% of the delivery notices for that month, accounting for 8.1 million ounces across 1,624 contracts. JP Morgan has been identified as the dominant short position holder in the silver market for more than a decade. The question being raised by market observers is whether that institution holds sufficient physical silver to meet potential March delivery demand, a question that Friday's First Notice Day data may begin to answer. With Friday's first notice day now less than 72 hours away, attention turns to the specific sequence of events and data points that market observers are monitoring across each of the remaining days leading up to that deadline. Each day carries its own set of indicators, and together they form a picture of where delivery demand may ultimately land when the official numbers are published. On Wednesday, February 25th, 2026, the day prior to first notice day, the focus falls on what is described as the final positioning day. By the close of Wednesday's trading session, market participants holding March contracts will have made their fundamental decision. Either stand for physical delivery or roll their position forward into the May contract. One of the primary figures to watch at Wednesday's close is the level of March open interest. A significant drop in open interest from the current figure of approximately 529 million ounces would indicate that a substantial number of contracts are being rolled forward to May, thereby reducing the volume of physical delivery demand. A more modest decline, however, would suggest that a large portion of open interest remains in the March contract and is therefore potentially standing for delivery. A second indicator being watched on Wednesday is silver lease rates, the cost at which silver can be borrowed for short-term delivery purposes. Under normal market conditions, silver lease rates are reported to range between 1% and 3% on an annualized basis. A spike in lease rates to 10% or higher would signal that market participants are experiencing difficulty sourcing physical silver to cover short positions, and would represent what analysts describe as a red flag for delivery stress. Additionally, March silver options are noted to have expired on Tuesday, February 24th, 2026. Heavy exercise of call options would convert those positions into futures contracts, some of which could then stand for physical delivery on Friday. Friday, February 27th, 2026 is identified as the central moment in the sequence. At approximately 2 p.m. Eastern Time, CME Group is scheduled to publish its delivery notice report for the March silver contract. That report will disclose the precise number of delivery notices issued by short position holders to long position holders. Each contract represents 5,000 ounces of silver, and multiplying the number of contracts by that figure produces the total ounces formally standing for delivery. The delivery notice report presents a range of possible outcomes, each carrying distinct implications for the market. If the reported figure is 4,000 contracts or fewer, that represents 20 million ounces or less of delivery demand. Under that outcome, COMEX registered inventory would decline to approximately 66.4 million ounces, and the exchange would be able to fulfill delivery obligations without significant strain. If the figure falls between 8,000 and 12,000 contracts, that translates to between 40 and 60 million ounces of delivery demand. COMEX would still be able to deliver, but registered inventory would fall to a range of 26.4 to 46.4 million ounces, leaving limited supply available for the subsequent May contract delivery period. If the figure reaches 15,000 contracts or higher, representing 75 million ounces or more, registered inventory would be reduced to near zero or potentially fall short of total demand. The day following first notice day, Saturday, February 28th, 2026, is also identified as a significant monitoring point. The official delivery process following first notice day carries a 3 business day settlement window. Saturday's developments, including any reports of delivery delays, cash settlement offers being extended to long position holders, or other procedural irregularities, would provide further clarity on whether the delivery process is proceeding in an orderly manner or encountering complications. Projected registered inventory heading into Friday morning is estimated at approximately 86.4 million ounces, based on a calculated average daily drain rate of 785,000 ounces, applied over the 3-day period from Tuesday through Friday. That projection is derived from subtracting 2.355 million ounces, the product of 3 days. 3 broad scenarios have been outlined to frame the range of possible outcomes from this delivery period. The first scenario describes an orderly rollover in which 15 to 20% of March contracts stand for delivery, actual physical movement of 20 to 30 million ounces occurs, and registered inventory declines to a range of 56.4 to 66.4 million ounces. Under this scenario, COMEX fulfills its delivery obligations, and the squeeze narrative, as it has been described, would be deferred to the May contract period. This scenario is assigned a probability of 25%, with the reasoning that recent delivery data, including the 98% February delivery rate and the 49.4 million ounce January figure, suggests strong participant preference for physical metal over contract rollovers, though COMEX has historically demonstrated tools to manage delivery month pressure. The second scenario describes a period of system stress, identified as the base case and assigned a probability of 50%. Under this scenario, 25 to 40% of March contracts stand for delivery, representing a demand of 132 to 212 million ounces. Physical delivery of 40 to 60 million ounces occurs, Registered inventory falls to a range of 26.4 to 46.4 million ounces, and emergency measures are triggered. Lease rates are projected to spike to a range of 10 to 20%. Cash settlement offers are extended, and eligible silver held in non-registered status faces pressure to be converted to registered inventory. The May contract would immediately face heightened scrutiny given the reduced inventory levels that would remain. The third scenario describes a full market break, assigned a probability of 25%. Under this outcome, 50% or more of March contracts stand for delivery, representing a demand of 265 million ounces or more against projected registered inventory of 86.4 million ounces. Under these conditions, COMEX would be physically unable to fulfill delivery obligations. Potential consequences outlined include a declaration of force majeure, the imposition of emergency cash settlements, or unrestricted price movement until sufficient physical supply emerges. Regulatory involvement at the level of the CFTC, the Federal Reserve, and the Treasury Department is cited as a possibility under this scenario. Historical precedents referenced include the Hunt Brothers silver episode of 1980 and the London Metal Exchange nickel market crisis of 2022. To summarize the core facts at the heart of this story, COMEX registered silver inventory stood at 88.79 million ounces as of February 19, 2026, down from 167.7 million ounces in October 2025, a 47% decline over 4 months. March 2026, open interest represents approximately 529 million ounces of notional exposure. The breakpoint at which registered inventory would be fully exhausted is a delivery rate of just 17% of outstanding contracts. Recent delivery rates have included a 98% rate in February 2026 and 49.4 million ounces delivered in January 2026, figures that stand significantly above historical norms for those respective months. At approximately 2 p.m. Eastern Time on Friday, February 27, 2026, CME Group is scheduled to publish the first notice day delivery report for the March silver contract. That report will reveal the precise number of delivery notices issued, and with it, the initial scale of physical delivery demand against available registered inventory. The data, when published, will be specific and unambiguous. This has been a full report on the COMEX Silver First Notice Day developments. We will continue to monitor this story as further data becomes available.